Starting with the foundation, when you invest in a company in the stock market, you are buying a piece of ownership in that company. Now, there's a couple different ways that you can go about in investing your money in the stock market. You can invest your money into an individual company, like investing in the McDonald's stock, or you can invest your money into a fund. So if you invest your money into the McDonald's stock, you can go into the stock market and buy one share of MCD, that's a ticker symbol for McDonald's, which will give you one piece of ownership, one share of the McDonald's company, which entitles you to a little piece of the McDonald's profits. But the risk you take when you invest in one company is if McDonald's starts serving really nasty burgers and people start getting sick and McDonald's goes bankrupt, all of the money that you invest in McDonald's goes to zero. But on the flip side, if McDonald's starts to dominate, they put Chick-fil-A out of business, they put Burger King out of business, they put Popeyes out of business, well, now McDonald's would grow their market share, they would grow their profits, and their stock would also become more valuable, which means you get to make a lot of money because the stock price grew a whole lot. So if you invest in an individual company, you take on a lot of risk, but you can also see more potential upside. The alternative to investing in an individual company would be to invest in a fund. There are three different types of funds. You have index funds, mutual funds, and ETFs. I'll explain what the difference is in just a second. But the general purpose of you investing in a fund is now instead of investing in one company, you can invest into a group, a basket of companies. So now instead of just investing in the McDonald's stock, you can invest in a fund that gives you ownership to McDonald's, Apple, Amazon, Coca-Cola, and maybe 500 other companies. So now you can go out and buy one share of this fund, and now you own a piece of, say, 500 different companies. That's the difference of investing in one fund versus one share of a company. And the advantage here is now if McDonald's were to go bankrupt, well, now this McDonald's stock would be kicked out and it'd be balanced out by some of the winners. So you have less risk, but also less upside. Now, all three different types of funds, index funds, mutual funds, and ETFs work similarly in that you're investing in a basket of stocks, but there are some nuanced differences. And many times people will use the word index fund to refer to everything, but I want to be a little bit more technical here. That way at least you have the background knowledge to understand what the difference is between each one of these funds. And there are three things that you want to pay attention to. Number one is, are these funds actively or passively managed? Are your fees higher or lower? And how often can you trade in and out of these funds? I'll explain exactly what that means. So index funds are generally passively managed. What that means is they're not managed by an individual person. It's not managed by a particular money manager. Instead, it's managed by a computer. So a computer will create an algorithm, maybe like investing in the S&P 500, meaning a group of the 500 largest companies in the stock market. You don't need a human being to decide what's the 500 largest companies. You can just train a computer to know what are the largest 500 companies. If a company starts to get smaller or they start to go bankrupt, well, then the computer can automatically kick one company out and put another company in. So these are passively managed funds compared to an actively managed fund, which needs a particular money manager to pick stocks. But when you have a computer managing these stocks, your fees are generally lower because now instead of paying a money manager, you're paying a computer, which doesn't cost as much as an expensive money manager. And the third thing that you have to understand about index funds is you can generally trade in and out of an index fund just one time a day. So if you have a stock brokerage account, you might know that if you wanted to trade a stock like McDonald's, you could do it in the morning, the afternoon, the evening, and every time in between, as long as the stock market is open. But when we're talking about real index funds, you can generally only buy or sell an index fund once a day. You can't trade in and out of them like you can a normal stock. Mutual funds work a little bit differently than index funds in that they are not passively managed, but they're generally actively managed. That means now you have a sophisticated money manager that's going to be picking stocks, not based off of some algorithm, but based off of what they believe is going to be the best fit for this fund, based off of whatever goal that you're looking to invest in. And because now you're paying an actively managed manager, well, now your fees are generally going to be higher. Now, you might say, well, what's the purpose of paying these higher fees? The pitch here is because you pay this money manager who's going to charge you a higher fee, the goal is for them to get you a higher return. Is it guaranteed? No, of course not. Investing has risks. But because you're paying these higher fees, the goal is to potentially get higher returns. But just like an index fund, you can generally only trade in and out of a mutual fund once a day. And then you have ETFs, which are kind of like a happy medium between index funds and mutual funds, because ETFs can either be passively or actively managed. Depending on what type of ETF it is, it could be either a low cost or high cost ETF. The passively managed ETFs are going to be low cost. the actively managed ETFs are going to have high costs, and I'll show you how to see these costs in just a minute. So this one is going to be, it depends, depending on what type of ETF it is that you're investing in. And I'm going to show you how to analyze that. But you can trade in and out of an ETF like a stock. So you can trade in and out of an ETF unlimited times during a day as long as the stock market is open. This brings us to point number 2, which is, should you be investing in these types of funds? And I gotta give you a little disclaimer here, because investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So, should you be investing in these funds? Now, I can't tell you what to do, but I'll tell you what I do. I invest in these funds. Particularly, I prefer ETFs just because it's a little bit easier for me. I like ETFs, but all of these are great, in my opinion. Now, does that mean that they're always good and all funds are good? No. This is where your analysis comes in to see what is it that you're actually investing in. Because for me, when I have my investing goals, they might be different than yours. I have particular investing goals in that I like cash flow. Most of the funds that I'm investing in are for cash flow purposes, meaning dividends. That means I like to invest in a fund that's going to pay me every 3 months. It's going to put some money into my bank account every 3 months, whether or not I sell. In fact, I don't really like this idea of selling. I'm not a big seller. I want to just buy more and have it pay me a bigger amount of money every quarter. That's the way that I like to invest my money, because I'm not a huge investor for appreciation. Appreciation is nice. If my stock market value goes up, great. If it doesn't go up, oh well. What I'm looking for is the cash flow, meaning how much money am I going to get paid every 3 months, because I can use that money to spend, and I know that I'm going to get more money every 3 months. That's the way that I like to invest my money. But you got to understand the risks. The first risk is an economic risk, which is that, well, if the stock market goes down or the economy goes down and the stock market gets hurt, your funds are probably going to get hurt. But if you want to be a smart investor when it comes to these types of funds, the goal is to be a long-term investor. That means you're not investing for 6 months, you're investing for the long term. That way you can withstand market crashes and market booms, because the reality is markets go up and they go down. We've seen a market crash pretty much every decade for the last century. And the second type of risk you want to pay attention to is more of an industry-specific risk. Meaning, are you investing your money into a fund that actually is going to be producing more value in 10 years, or is it going to be more bankrupt in 10 years? Now, there are funds for pretty much anything that you can imagine. There are funds that give you exposure to the general stock market, like total stock market ETFs or S&P 500 ETFs. You also have funds that give you exposure to things like healthcare and technology and emerging markets and dividends. But then you also have even more niche index funds, or funds in general. You have funds that will give you exposure to things like diversity, equity, and inclusion companies. You have funds that will give you exposure to companies that are investing in electronic cars. You have funds that will give you exposure to artificial intelligence companies. You have funds that will give you exposure to the blockchain. So this is where now, if you're investing in a niche fund, you want to be thinking about, is this something that you believe will have more value in 5 years, 10 years, and 20 years, or will it have less value? Again, I'm not here to talk politics. I'm not here to tell you what's right or wrong. I want you to understand this from a financial perspective, that there are many different ways to analyze and pick these funds, because there are funds for anything that you can imagine. But you want to be investing your money into something that you believe will have a lot more value in the future than today, because if you don't believe it's going to be more valuable in the future, why would you invest your money into it? If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.